I'm going to discuss my current investment posture in this video based on my concerns about the economy and stock market valuations using traditional valuation metrics. I have found myself becoming more conservative in my investments. Fidelity was describing my investment approach prior to this year as being conservative, which was, I believe, a very liberal description of the risk-taking skill in that account. But Fidelity has now dropped that characterization altogether and simply calls my investment style short-term. I have other taxable accounts at Vanguard and Schwab and Interactive Brokers, and they are managed much in the same way, except for the Vanguard account, where about one half of it is in their high yielding or higher yielding than most federal U.S. Treasury money market funds. I am not thinking long term at the present time when interest rates are high enough as they have been for the past 2 years, that my relatively conservative portfolio weighted in interest paying securities more than more than covers my living expenses, including extraordinary items, after I pay taxes on the income. But that approach may not work in the future, requiring me to up my dividend paying stock allocation sum, which I did during the low interest rate period during the Fed's jihad against the savings class that lasted from 2008 for most of the years until 2022. My investment approach, for those who read my blog, has become increasingly conservative due to my age and financial condition. Most of my investment portfolio now is in investment grade corporate bonds, Tennessee municipal bonds rated AA or better, T-bills purchased at auction, Treasury notes purchased primarily in the secondary market, some at auction, some FDIC insured CDs that are starting to roll over, and I'm not buying any new CDs now, and Treasury money market funds. I use a ladder approach, meaning that I have securities maturing starting every next week and every week thereafter for the next 2 years. The longest maturity that I currently have is five high quality municipal bonds that mature in 2046. But more than 70%, I should say, of the securities mature within 2 years. Most of the yield over the past 2 years could be acquired with short-term maturities, and nothing much was gained by going further out in time as far as yield is concerned. This year, I've been buying more bonds maturing in 2028, and the figure is probably close to $100,000 so far this year, and the principal amount maturing that year is currently within my monthly range for maturities in 2025. So I'm not yet really into the years after 2026. The downside in this approach of focusing on shorter term maturities is that the economy may experience soon enough another downturn, with the Fed continuing to lower the federal funds rate as a stimulative monetary policy, and even possibly returning to ZIRP, which stands for zero interest rate policy, that would cause short-term rates to fall back to near zero again. That cannot be discounted as improbable or even unlikely anymore, given that both ZIRP and QE were in effect for most of the period between 2008 and 2022, and kept in place in 2021 even when inflation started to surge. Having lived through the 1970s, and I was an investor back then, but I was concentrating more on short-term CDs that were insured by the FDIC than stock investments at the time. At one point, I was receiving 15% or more on 3-month CDs around 1980, 1981. During that period of time, I did invest in stocks, and I was fully aware that the problematic inflation of that period and the high interest rates had caused both stocks and bonds to fail as asset classes, and that lasted for both asset classes over about a 16-year period, starting in January 1966 through July 1982, and that was due to prolonged periods of high inflation and high interest rates. Given that history that I have of actually experiencing the high inflation and having to make investment decisions during that kind of period, my tendency now is to believe that the first job of the Federal Reserve is to prevent problematic inflation becoming embedded in the economy, and I'm defining that as persistent annual CPI increases of 4% or more, even if that means a rise in the unemployment rate. The failure to address emerging inflation throughout 2021 and actually contributing to the high inflation numbers by keeping the highly expansionary monetary policies of ZIRP and QE throughout that year was a huge policy error. I've described it in the past as the second biggest policy error ever made by the Federal Reserve Bank. But it also indicates to me that the Fed may do the same when faced with a choice between contributing to problematic inflation with stimulative monetary policies or fighting inflation with higher rates that lead to a significant rise in unemployment. I believe that they will err on the side of letting inflation run rather than unemployment running much higher. Since I'm concerned about the Fed going back to ZIRP, I have started to go further out in time with corporate bond purchases. Some of my recent purchases since I last published a blog post on February 10th, 2025, have been first mortgage bonds issued by electric utility companies, and that sort of indicates where my mind is at right now. When going out on first mortgage bond maturities to 2033 to 2035, as I've recently been doing to a very small extent, I want at least a 5% coupon and a discounted price to par value. I am buying only in one bond lot so far. I can find bonds that are first mortgage bonds issued by electric utility companies where the best ask price is for a one bond lot, and so that's what I'm buying. If interest rates move higher for maturities in that time frame, I can then average down by buying more in one bond lots. But this makes me feel comfortable a little bit now, more so that I'm doing something addressing the possibility that the Fed will continue to lower the federal funds rate and may even return to ZIRP at some point later this year or in 2026 or 2027. And although I'm fairly well prepared for 2025 through 2027, my bond portfolio really drops off starting in 2028. In previous videos, I discussed first mortgage bonds issued by operating subsidiaries of Entergy and Duke Energy, which I will link in the More section below. There are two operating subsidiaries of Xcel Energy called Public Service of Colorado and Northern States Power of Minnesota. that issue first mortgage bonds. I recently bought two of the Public Service of Colorado first mortgage bonds maturing in 2028, and I discussed that purchase in item number 5G. I think that was in the February 5th post. The YTM was over 4.7% somewhere, which is fine for me for that kind of quality bond maturing in about 3 years. I also own a first mortgage bonds issued by the Public Service Electric and Gas Company, which is a subsidiary of the Public Service Enterprise. I think the stock symbol is PEG. I only own two of those bonds, and one of those first mortgage bonds matures in March of 2025. I have not yet started looking for others to replace the ones that are about to mature.